From the outside, a $5 million retirement looks like the dream. No boss, no commute, plenty of cushion. But a few years into early retirement, I often hear a different story. Yes, we're comfortable, but why is our tax bill so high? That's usually the moment people realize that withdrawals, conversions, and timing matter just as much as investment returns. In this video, I'll walk you through a detailed $5 million early retiree case study to show you the massive impact proactive planning has on anyone with a multi-million-dollar net worth. If you're new here, I'm Rachel Camp, a CFP professional and the founder of Camp Wealth, and my firm works exclusively with early retirees. That's those who want to leave work before age 65. And today we're going to talk about what's really happening underneath a multi-million-dollar portfolio and the practical planning moves that can keep more of your money working for you instead of going to the IRS. So this is what a $5 million retirement actually looks like. As always, this video is for educational purposes only and is not personal financial advice. Your situation is unique, so make sure you consult your own financial planner and tax professional here. Let me walk you through a hypothetical example of a couple, Ben and Leslie, to illustrate how planning decisions can affect a $5 million retirement. So Ben is 59 years old and Leslie is 58. They're both retiring this year from successful careers in Indiana and retiring to Texas. Together, they built a $5 million nest egg. Ben has $1.7 million in his traditional IRA and $150,000 in his Roth IRA. Leslie has $1 million in her traditional IRA and $150,000 in her Roth IRA. And together, they have a joint brokerage account with $2 million in it. So roughly $2.7 million in pre-tax sitting in IRAs, $300,000 that's already in Roth accounts, and $2 million in taxable investments. This retirement nest egg puts them in the top 0.1% of households. Now, many people may be thinking, what do Ben and Leslie possibly have to worry about? They are set. But let's talk about the problems almost every big balance retiree runs into. With a $5 million retirement, the question is rarely, will I run out of money? Although sometimes it is, depending on spending. But most often the question is, how do I avoid overpaying taxes for the rest of my life, especially when so much of my money is still in pre-tax accounts, meaning it has yet to be taxed? Ben and Leslie's biggest risk is not market crashes, it's tax creep. And these problems affect many early retirees starting retirement with a few million. As their balances grow, they're on collision course with ACA health insurance subsidies in their 50s and early 60s, Medicare IRMA, Social Security taxes at the highest level, 15% or potentially higher capital gains tax rates instead of 0%, and also possibly 3.8% of net investment income tax. An annoying twist, a lot of these are based on some version of MAGI or modified adjusted gross income. But MAGI is defined differently depending on whether you're looking at ACA subsidies, IRMA, or net investment income tax. So you don't just have one line on your tax return to watch, you have several. And what do most high net worth retirees do when this feels confusing? They freeze. They leave their IRAs alone to let them grow. They push Roth conversions off and they tell themselves that they'll deal with the taxes later. But that is how you turn a $5 million nest egg into a lifelong tax problem, because the Roth conversion window does close, and for many people, especially early retirees, that window is shorter than they might think. If all of this already feels overwhelming, and I apologize for the jargon, but that's normal, there is no simple online calculator that says, click here and we're going to coordinate ACA subsidies, Roth conversions, capital gains, IRMA, Social Security tax, and RMDs perfectly. Instead, it feels like this giant moving puzzle. Let me show you why it feels so confusing with just one example I see a lot. So imagine you and your spouse drop into the 12% federal tax bracket in retirement. You might think, great, any Roth conversions I do, taxed at 12%. But if you're also in the 0% capital gains tax bracket, that extra dollar of Roth conversions can quietly push $1 of qualified dividends or long-term gains from 0% up to the 15% bracket. So that simple 12% Roth conversion is actually a 27% marginal tax hit. That's 12% on the conversion plus 15% on the gain you just bumped up. You didn't do anything wrong. The tax system is just layered. And this is why rule of thumb thinking, like never pay taxes before you have to, can quickly backfire for couples like Ben and Leslie. What they need is a coordinated plan that reduces lifetime tax, not just this year's. Now, before we get deeper into tax maneuvers, we are going to start with their desired retirement income. Once I know how much Ben and Leslie would like to spend, I know the tax impact we're facing and how to work around it. So let's say Ben and Leslie want to spend $180,000 per year before tax and retirement. With a $5 million portfolio, that's roughly a 3.6% withdrawal rate. That's a very safe withdrawal rate. Like I said, with Ben and Leslie, the risk we are focused on is not running out of money. It's a huge tax tip that goes to the IRS instead of their children or charities they care about. Now that spending is set, we go into the strategy. So which accounts do they tap when, and how do we use taxes to their advantage instead of just reacting? And that's where the 5 distinct phases of retirement come in. Phase 1 we have for early retirees is the health insurance subsidies phase. So for Ben and Leslie, this first phase starts right away when they retire and runs until each of them hit Medicare age. Here, the focus is simple: keep income low. Why? Because ACA health insurance subsidies can save them thousands per year. And these subsidies are based on their household income, not their account balances. So with a $2 million taxable account, Ben and Leslie have a secret weapon. They can fund all of their retirement spending in the early years from their brokerage account while showing relatively modest income for ACA purposes. That's health insurance subsidies. Imagine that their $2 million brokerage account has a roughly 50% of embedded gains. So if they need $180,000 from that account for living expenses, only about $90,000 of that might show up on their tax return as a capital gain. And the 0% capital gains tax bracket for a married couple in 2026 goes all the way up to $98,900 for taxable income. That's a very different picture than pulling $180,000 directly from an IRA, where all of it is taxable income. So in this phase, Ben and Leslie's strategy might look like this. First up, asset location is critical. So they are going to place interest-bearing investments like bonds in their traditional IRAs so that interest doesn't hit their tax return each year. We want to fill up these lower tax brackets with long-term capital gains, and if we have bond interest filling it up, it makes it very difficult to do. Then we're going to put high-growth assets in their Roth IRAs and HSAs if they have them. Let these grow tax-free for as long as possible. Finally, in the taxable account, we are focusing on tax-efficient, low-turnover funds to keep realized gains and dividends controlled. So we have to be careful with dividends here. And I see a lot of people go wrong in this area. Even the dividend yield alone in a large taxable account can bump you into higher tax brackets. Huge high-yield funds and taxable accounts can become a tax headache very quickly. I know many people become interested in dividend-focused funds in retirement, but keep in mind, high dividends decrease our tax flexibility because we have no control over that income. Selling a fund and realizing the gain, we have complete control over when and how much we do. Third thing we're going to do in this phase is to prioritize ACA subsidies over Roth conversions. This is situation dependent, but for many people, the benefit of the ACA subsidy, which is a tax credit, tends to outweigh Roth conversions, at least initially. And we will have time for Roth conversions later. For Ben and Leslie, they must be mindful of their reported income in the early years. So phase 1 is all about living well from taxable assets, keeping ordinary income low, and preserving ACA subsidies while they can. Now, once Ben and Leslie are on Medicare and ACA subsidies are off the table, but before Social Security and RMDs kick in, we enter what we call the Roth conversion golden window. This is phase 2, and it occurs from age 65 to 70. So they are on Medicare, so no more ACA premium tax credits to worry about. And also, Social Security and RMDs still have not kicked in yet if they delay Social Security to age 70. Now, this does get a little more complicated if the couple has a larger age difference. If Ben were, say, 5 years older rather than 1 year, he would jump on Medicare, but you would still need to manage reported income because Leslie would still be on marketplace insurance for a while. As it currently stands for them, this phase is prime time for Roth conversions. So here's why this period is so powerful. Ben and Leslie can still choose how much taxable income to generate because they have plenty left in their brokerage account at this point. So we are still working with their base income coming mainly from long-term capital gains and qualified dividends. They continue to get the standard deduction like all Americans do, unless you itemize. But based on current tax law, at age 65, they now qualify for senior deductions. So if we were to assume they were both age 65 this year in 2026, they would each get an extra $1,650 or $1,650 on the standard deduction, raising the standard deduction from $32,200 to $35,500. On top of that, with the most recent tax code change, We now have enhanced senior deduction up to $6,000 each if we're able to keep their modified adjusted gross income below $150,000. That means, again, based on current tax code and these enhanced senior deductions, and they are currently temporary, but it means $47,500 as completely tax-free income just to start. So if we were to assume Leslie and Ben enter phase 2 today, meaning they're both 65, at least 65, and they need $180,000 in income, and we want to do Roth conversions, we can start the analysis with first working around what they need in income. So let's assume they already get about $40,000 in qualified dividends from their brokerage account. They also get $6,000 in taxable interest from some bonds that they have. And now we need another $134,000 for their income, which would generate $67,000 in long-term capital gains. So we find that they actually have room for a $33,400 Roth conversion while still paying $0 in tax. After this point, they must determine if they'd like to do additional Roth conversions, which would bump them up into the 15% capital gains tax bracket. And we're also starting to bump up against the $150,000 in modified adjusted gross income, which comes into play for qualifying for the enhanced senior deduction. So this is a great example for how everything is layered in tax planning, and there's usually multiple things we have to think about. The other thing that enters the picture at this point is IRMA, or Medicare Income-Related Surcharge. And IRMA works like a step function, meaning crossing a certain income threshold by even $1, and your Medicare premiums can jump for the entire year. The first threshold currently sits at $218,000 for modified adjusted gross income. So Ben and Leslie in our sample scenario here are still well under. Now think of phase 2 as we're going to intentionally raise our taxes now to lower them later. This is the hardest thing for the human brain to accept because it feels like volunteering for pain. But for high net worth couples, this is where a ton of lifetime savings lives. Now, once Ben and Leslie hit age 70 and claim Social Security, we enter phase 3. Social Security is now flowing in, great for cash flow, but it also starts to fill up the lower tax brackets. For affluent retirees like Ben and Leslie, delaying Social Security to age 70 can be especially attractive because it keeps their tax return cleaner in their 60s. It gives them more room for Roth conversions in phase 2, and it increases their guaranteed income in later life. So in this stage, their toolkit looks like this. Smaller, more surgical Roth conversions, because for Ben and Leslie, Social Security will occupy all of that 10% bracket and some of the 12% bracket, even after deductions. Also, qualified charitable distributions starting at age 70 and a half. They can give directly from IRAs to charity and exclude those distributions from income. Carefully managing capital gains so they don't stack too aggressively on top of Social Security and IRA conversions. If they're already living from traditional IRA withdrawals in their 70s, those withdrawals are naturally shrinking future RMDs, which means they may not need to push super hard on conversions anymore. In other words, in phase 3, the Roth conversion playbook moves from big, bold moves to just fine-tuning before we jump into the next phase, where we almost certainly will not have any room left for Roth conversions. Next, we hit the RMD phase, currently at age 75 for people their age, and this is the phase most people fear. They picture the IRS forcing us to take huge taxable withdrawals, whether we need the money or not. And sometimes, yes, those RMDs can be large. But for couples like Ben and Leslie who used phases 2 and 3 wisely and already shifted some balance into their Roth, RMDs are often more manageable than they expected. Here's what works in their favor. High standard deductions based on current tax law, additional senior deductions, generally lower tax brackets than they faced in peak earning years, and ongoing use of qualified charitable distributions if they are charitably inclined. So in phase 4, the focus often shifts to RMDs are now just part of their ongoing retirement income. We are still using QCDs strategically and making sure their withdrawal pattern still supports their lifestyle and long-term goals. Now, this last phase, phase 5, is the one it's not fun to talk about, and it's only applicable to married folks. But it's critical, the widow or widower phase. At some point, one spouse is likely to outlive the other. And when this happens, the surviving spouse often keeps most of the same income, but their tax filing status shifts from married filing jointly to single. So that means bracket thresholds shrink, IRMA thresholds are lower, and the same level of IRA withdrawals and RMDs can push the survivor into much higher effective tax rates. So when we're doing Roth conversions for Ben and Leslie in their 60s, we're not only thinking about their joint taxes, but we're also thinking about what happens when one of them is alone with a big IRA in single tax brackets. Roth assets and thoughtful RMD planning can make that phase less painful. In these final phases, you can also start to think about gifting to the next generation and increasing charitable contributions. There are some advanced practices here in this category, so do not wing it. It's worth bringing a professional in here. So, what does a $5 million retirement actually look like? For Ben and Leslie, it looks like a very comfortable lifestyle, yes, but also potentially a 30-plus year tax project. The money piece, the $5 million, they already did. Now the question is, do we manage this intentionally, phase by phase, or do we let the tax system make the decisions for us? Over time, the difference can be significant, and in some cases may meaningfully impact lifetime taxes. Now that you've seen what a $5 million retirement actually looks like, you can start focusing on protecting the structure behind your wealth. If you want help building your dream retirement, click the link below to book a call with my team, or we'll connect you with one of our partners. We want to provide the right solution for everyone. I'll see you in the next video.